All right, ladies and gentlemen, I hope you had a wonderful day. It was a wild day of no news and big moves on the market, but we got to talk about dividend stocks because the volatility that last week created and the volatility we are setting up for with Powell this week, it is creating a big opportunity, and now is the time to lock in your dividends. So we got a lot to talk about. I have the plays, I have the keys, all that good stuff. I'm going to talk about what to expect tomorrow briefly, then a little bit about Friday in Jackson Hole, and then we are going to talk about dividends and what I did here today because I actually made a pretty big move. One, I want you to observe how the long term after last week, we saw one of the biggest long-term dips we have gone through, and then fast forward till today, we are now hitting a new record. And what I ended up doing today, I decided to buy Whirlpool stock. It is a 7% dividend. It is a big name. Most of you know about Whirlpool. You might even have it in your house. It is a value play that has been struggling, but I thought I would go with the risk and lock in some dividends because now might be that moment given what we just went through and where things are about to go with the September rate cuts, the end of the year, the election, and all of that good stuff. So we're going to go over all of that. I have that recap for you. What I need from you, Chattadonia, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/The Stack Market. We will see you there in the morning, baby. Run it.
The couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it down.
But right off the bat, before we get into the keys, let's just take a look at what today's market offered us, and it was a 1% move on the S&P and NASDAQ. We gapped up a little bit, and then all we did was go straight up. There was the Conference Board of Consumer Confidence and little bits of data, but there was zero reaction. We woke up to comments out of Fed Dolly and a couple of other speakers. None of that really got in the way, and it just seemed like today was all about getting ready for Jackson Hole, and the fact that things calmed down, people were feeling good, even though the Japanese yen got a little bit of strength and the Japanese stocks didn't do that good. We brushed things off, and this was kind of like a message of, hey, we're all focused on Powell. Things were good. We are over this idea of freaking out. This is really solidifying this idea that last week was a fluke. Now, I have a couple of problems with that. We'll see how this plays out, but in a weird way, it seems like if the market is waiting to react negatively, why would you do it now? Why would you do it unless Japan moves? And then ultimately, why do anything until Powell speaks on Friday? That is going to pretty much be the mantra leading into Friday. So that's the big deal of what got us here. But now, this is what I want to explain to you. There's two things going on. One, as far as the short term and what we are dealing with this week, I want you to understand Jackson Hole isn't really that big of an event. Historically, nobody really cared about the Jackson Hole Symposium. It was held by the Kansas City Fed. It's an event where they bring the Fed speakers out to Wyoming. Yeah, there's been a lot of talk about it, but you never really had this much of the world and the media actually paying attention to it. It wasn't until 2022 where Jay Powell was starting his rate hiking, or he was already really in the middle of hiking rates, and he said there will be pain, and reminded people of what he was going to do with the rates in 2022, only to shortly pivot a couple months later, and that caused a really negative reaction. And ever since then, everybody in the media and a lot of traders have been saying, oh my gosh, Jackson Hole, and really been freaking out. So that being said, why I'm bringing this up to start, because you see how the market is already moving big today. It seems like everybody is waiting for this event, but the irony of all of it, this just is getting to the point where this is just being gamed up by the media. I think everybody wants the clicks and views as everybody swarms around this event. It really shouldn't cause much, but the way I'm looking at it, it's very simple. if there is going to be a big move ahead of Jackson Hole on the market, we keep moving 1-2%, and everybody's like, oh yeah, we feel good, and we keep ripping. The bigger the move ahead of Jackson Hole, if Powell comes in and does absolutely nothing, then I think we're going to get absolutely zero movement, if not sell off. Otherwise, if we barely move ahead of Jackson Hole, I think that'll be the best opportunity we get to Jackson Hole actually becoming an event. So what I'm trying to say here, if the market moves a lot into Jackson Hole, I don't think Jackson Hole is going to be an event. If we kind of stay max the top end of where we're at today, then I think it'll be a really good one where maybe we'll get stuff. Other than that, it really does boil down to what Jay Powell says, but there is a lot of overreaction leading into this. So keep that in mind. That's the first big thing. But now, number two, as related to the dividend stocks, why did I buy Whirlpool today? Why do I think you should be looking at these dividend stocks? Because think about it. What just went down? You had a big market sell-off. There was a correction in some names, and some value names held up. Some didn't. You got to learn a lot. Like literally go look at how MO held up within all of this, but it's very simple. If that was an overreaction, the market's going to recover, and we're going to have a green light until September or even after in the election. If there is going to be this everything rally and there truly is a soft landing, everything is fine, then value stocks can get supported. There's a good opportunity to start scooping up value names. Yeah, we cut rates and things get lowered, but if there's a soft landing, consumer, everything else is good, you should see everything go up, and you could lock in the high yields. That is one scenario. The other scenario, if we actually do get the market turning around, we get more volatility August, September, we get the rate cuts, and then things start to turn around, and then the Mag 7 sells off, and we do get a little bit of a correction there. What did we get to learn from the last couple of weeks? You can very well see Mag 7 sell off, and the value names get a bid. So what I'm trying to say here, you're damned if you do, you're damned if you don't. As we get into September and where the economy is going, some of these bigger, valuable names that have been around for a while, again, Whirlpool literally founded in 1911, some of these names that pay a high dividend and they are offering a lot, this could be a good time to lock them in, because if everything is fine and we get a soft landing, they're still trading near lows. And if we do run into a problem and we watch the rates and things change and a flip-flopping in the leadership, they can also benefit as well. So this is why I was thinking, you know what, I'm going to go ahead. I even did go on margin for the long term. A lot of people are freaking out about it, but I used to give myself bonuses. You guys remember that for the long term? So I said, hey, I'll just advance myself 1 month as we're about to get, or a month and a half as we're about to get the next month here in about like a week or so. So that's what I wanted to talk about. That's what I wanted to show you. And like I already showed you at the beginning of the video, we are reaching a new all-time high. Even if you go to the small YouTube account, that thing is also hitting all-time highs too. So this is all great for the account. And this is what I was trying to say, like, hey, I do not like the short term, and I think there's going to be a lot of volatility and uncertainty with everything going on, but I am very, very bullish and feel very confident in the long term. And then word to that, by making this purchase today with Whirlpool and by locking in these dividends, again, I want to lock in a 7%er now, because if we do transition to a lower rate world, I don't think these 7s and 8s on some of these higher quality names, I don't think they're going to exist anymore. So that's why we want to lock them in today. But now, after today, if you remember, when this account was just at 150 at the beginning of the year, we were talking about our dividend goal, and now I have reached it and accomplished a 50% dividend increase from the year prior. So this was a big goal of mine. I'm very glad. Again, we were only making $4,000 a year in dividends. Now we're up to $6,000, and I'll have a couple of months. So I did advance myself till October, but then the last couple of months we'll have a little bit more flexibility to stack up growth or dividends and then go from there. So shout out to the long term, and again, free long term alerts if you guys want any of those, or we sent those out. You should have got those today, but those are the two big things I wanted to talk about. And then now coming into tomorrow, sadly, it is going to be just as uneventful as today, but you see that the market can very well make moves, and we're going to find out tomorrow whether or not things really want to move ahead. We're going to find out, yeah, the market wants to run ahead of Powell. They're going to feel confident on it, and if that's the case, lower probabilities of having a big event on Powell, and then vice versa. If we kind of get no news, chill out a little bit, see what happens with bonds and some of those other things. Maybe we get to advance this story and then get a little bit of a holding pattern until the big event. So should be very straightforward, and that's why too, like I said, remember, it was a slow market until September 1st, and now after this week and then leading into NVIDIA next week, before you know it, summer is over, then we get back into real volatility volume and the end of the year. So I hope you're ready, but now let us get into the plays. So right off the bat, before I go into the plays, I made a couple of plays today, and the first one, TNXP, this was that lower sketchy penny stock MPOX play that we were talking about last week. If you were there live on stream, you got the stream alerts, you know we made this play here. I was able to sell out in the morning, just 30-40 minutes in. It gapped up there. They had it wasn't earnings, it was an update on their cash position, but it was good. And then literally all of the monkeypox plays this morning, they started running up, so I sold out of this one for $1,200 in profit, and then it dropped 5 cents lower, about 10% lower than where we bought it from, and at the end of the day, I double dipped, so I got back into it. I'm holding these overnight. We'll see where that goes, and really why I double dipped, because not only didn't it drop, but end of the day, there was another WHO headline on more spreading, but people are still carrying this over. So I do think this is just going to be headline. I don't think it's a big deal and you should worry, but for your life, that is. And I don't think it's going to cause too big of a movement, but I think the stocks, it's going to be a game of Russian musical chairs, aka very dangerous. So watch out for that. But that was the first play. Then I shorted ZB. I don't know. The futures are open right now. Yeah, they are. I'm still up on that. I was up even from throughout the day. I shorted at 124.11 on ZB. And I think that one has about 10 days, so I do need to close this soon, but I'm already up $200, and why is because bonds went up again. Remember on Friday, I was saying bonds shouldn't be up. I was even saying all day today, even just with how everything recovered, this doesn't make sense to me. So it's cool if it really is an overreaction, whether people want to be worried about soft landing, no landing, it doesn't matter. I'm not here to judge it all, but none of this makes sense with the bonds still holding up. The way I'm looking at it, see how where we were, bonds were kind of rallying, but holding around here as we were already hitting that all-time high. So now bonds are getting more bullish and we're not even back to that other high. I'm not really buying it with how the data has played out. So finally, instead of kind of just talking about it, I said, you know what, let me short a ZB. It's a little risky because I don't want to get blown out on anything. This is a finicky market. A lot of things don't make sense. So it can just go against you for no damn reason, and that's what I'm worried about. But I do think that the bond should be coming down. So we'll see how that plays out. But that was my second and only other play, and then I added Whirlpool shares for the long term. I have 6 shares on the small account, the YouTube one, the $300 a month deposit, the $3,000 one, the Fidelity, the big account. I grabbed 60 shares, and then Colt's sister, since she doesn't have margin and we couldn't get an advance on that one, she keeps her account. She hasn't raised her deposit in years. She keeps it at 200. We only were able to get her about 2 shares of the stock there in Whirlpool. So that's all I did today. Other than that, though, what I am looking for, just 2 plays for tomorrow. Number 1, gold. I did not make any plays on this, but I feel like it made a very soft entrance today after hitting record highs on Friday. So I don't have any moves. I will be eyeing an MGC or a GC. Just really depends. But again, I don't like above 2,500. I'm kind of inclined to short it, but last time I shorted it got smashed. Otherwise, I am going to wait as we get closer to either data or Powell, or even I think more towards September. This might be a play, but I do want to see what signal this gives us and watch out between the relationship between gold and silver. Remember, silver was outperforming, and then after this last week, that kind of changed around a little bit. So watch out for that. That is play number 1. Then play number 2, and this is your final one, Target. I think this one could be a big one. I think it's going to be a sleeper. And one, they have earnings this week, but Walmart kind of got a decently big reaction. We got to hear surprises out of Walmart or HD as well. And in the beginning, we were a little worried about the consumer. Remember Nike and all that. So I'd watch out for Target. They've kind of even moved 30-40% from their last recovery zone. So this could be big, but if it is pricing too much with all this volatility, I think that'll suck all the life out of any play. So watch out for that. It should be interesting, but that is play number 2. And the final play, I think it's time. We had to wait with all the volatility. I got another economic lesson, baby. It is time for balance of payments adjustments. So we're still talking around the monetary policy and exchange rate systems. We are still on chapter 10 or 11? I even forgot. But if you guys remember, we were talking fixed and floated, and we were talking what the balance of payments was, and now what happens when you run into an unequal amount of trade, you buy or sell more from the other person. How do you end up adjusting that? That's what we're going to talk about. So getting into it, balance of payments adjustments, even though the current and capital accounts must balance each other, there is no assurance that millions of international transactions that individuals, businesses, and governments conduct every year will be necessarily producing this balance. When they don't, the country faces an imbalance of payments. A country might have a current account deficit that it cannot fully finance through capital imports, for example, or it may have a current account surplus that is not fully offset by capital outflows. When an imbalance arises, the country must bring its payments back into balance. The process by which a country does so is called a balance of payments adjustment. Fixed and floating exchange rate systems adjust imbalances in different ways. In a fixed exchange rate system, balance of payments adjustments occur through the change in domestic prices. We can most readily understand this adjustment process through a simple example. Suppose there are only two countries in the world, the US and Japan, and suppose further that they maintain a fixed exchange rate to which $1 equals 100 yen. The United States has purchased 800 billion yen worth of goods, services, and financial assets from Japan, and Japan has purchased 4 billion of items from the United States. Thus, the United States has a deficit and Japan has a surplus of $4 billion. This payments imbalance creates an imbalance between the supply of and the demand for the dollar and yen in the foreign exchange market. American residents need 800 billion yen to pay for their imports from Japan. They could only acquire this 800 billion yen by selling $8 billion. Japanese residents need only $4 billion to create or to pay for their imports from the United States. They can acquire the $4 billion by selling 400 billion yen. Thus, American residents are selling $4 billion more dollars than Japanese residents want to buy, and the dollar depreciates against the yen. So again, this is giving you an example, but hopefully you're remembering again the whole supply demand of currencies, how this affects values. Is this what happens today? Yes. Is it more complex? And is there more than two countries that hold a peg? Yes. So continuing, because the exchange rate is fixed, the United States and Japan must prevent this depreciation. Thus, both governments intervene in the foreign exchange market, buying dollars in exchange for yen. Intervention has two consequences. First, it eliminates the imbalance in the foreign exchange market as the government provides the 400 billion yen that the American residents need in exchange for the 4 billion that Japanese residents do not want. With the supply of each currency equal to the demand in the forex market, the fixed exchange rate is sustained. Second, intervention changes each country's money supply. The American money supply falls by $4 billion, and Japan's money supply increases by 400 billion yen. The change in the monetary money supplies alters the prices in both countries. The reduction of the U.S. money supply causes American prices to fall. The expansion of money supply in Japan causes Japanese prices to rise. As American prices fall and Japanese prices rise, American goods become relatively less expensive than Japanese goods. Consequently, American and Japanese residents shift their purchases away from Japanese products and towards American goods. American imports and hence Japanese exports fall, and American exports and hence Japanese imports rise. As American imports and Japanese exports fall and American exports and Japanese imports rise, the payments imbalance is eliminated. Adjustment under fixed exchange rate thus occurs through changes in the relative price of American and Japanese goods brought about by the changes in money supplies caused by the intervention in the foreign exchange market. So if you're not getting in this fixed exchange system, again, if you're trading with just two countries and you're trying to buy more than you have, it creates this imbalance. So how are these residents going to trade if they need more dollars or yen? And then if you're on a fixed exchange to try to keep it the same, you come in and intervene, but then as a result, the intervention alters the money supply in a fixed system, and then the money supply alters domestic prices, and then that changes behavior, and then therefore the balance of payments, it goes away as the change in prices changes in behaviors, and then things balance out over the midterm, short term, and even the long run. So that's a fixed exchange rate. balance of payments adjustment. In a floating exchange rate, balance of payments adjustment occurs through exchange rate movements. Let's go back to our U.S.-Japanese scenario. Keep everything the same, except this time allow the currencies to float rather than requiring the governments to maintain a fixed exchange rate. Again, the $4 billion payment imbalance generates an imbalance in the forex market. Americans are selling more dollars than Japanese residents want to buy. Consequently, the dollar begins to depreciate against the yen. Because the currencies are floating, however, neither government intervenes in the forex market. Instead, the dollar depreciates until the market clears. In essence, and Americans seek the yen they need. They are forced to accept fewer yen for each dollar. Eventually, however, they will acquire all the yen that they will need to have paid more, but they will have paid more than $4 billion for them. The dollar's depreciation lowers the price in yen of American goods and services in the Japanese market and raises the price in dollars of Japanese goods and services in the American market. A 10% devaluation of the dollar against the yen, for example, reduces the price that Japanese residents pay for American goods by 10% and raises the price that Americans pay for Japanese goods by 10%. By making American products cheaper and Japanese goods more expensive, depreciation causes American imports and Japanese imports to fall and American exports to Japan to rise. As American exports and expand and imports fall, the payments imbalance is corrected. In both systems, therefore, a balance of payments adjustment occurs as prices fall in the country with the deficit and rise in the country with the surplus. Consumers in both countries respond to these price changes by purchasing fewer of the now more expensive goods in the country with the surplus and now more of the cheaper goods in the country with the deficit. These shifts in the consumption alter imports and exports in both countries, moving each of their payments back into balance. This mechanism that causes the price changes is different in each system. In fixed exchange rate systems, the exchange rate remains stable and price changes are achieved by changing the money supply in order to alter prices inside the country. In floating exchange rate, internal prices remain stable while the change in relative prices is brought about through the exchange rate movements. Contrasting the balance of payments adjustment process under fixed and floated highlights the trade-off that governments face between exchange rate stability and domestic price stability. Governments can have a stable fixed exchange rate or they could stabilize domestic prices, but they cannot achieve both goals simultaneously. If a government wants to maintain a fixed exchange rate, it must accept the occasional deflation and inflation caused by balance of payments adjustment. If a government is unwilling to accept such price movements, it cannot maintain a fixed exchange rate. This trade-off has been the central factor driving the international monetary system towards floating rates during the last 100 years. We turn now to examine how this trade-off first led governments to create an innovative international monetary arrangement following World War II and then caused the system to collapse into a floating exchange rate system in the early 1970s. So I think that's it. And then we're going to get into the Bretton Woods system, but hopefully you're seeing here, it's understanding again all of the trade that goes on. What you really need to understand is, one, countries trade with each other. You cannot buy and get more than you have. So if we're importing and buying billions of dollars of goods, we're getting it through our financial account. Again, what happens when that doesn't happen is like, where do you get that money? You need a balance of payment adjustment. If you run deficits and surplus over time, these balance of payments adjustment is usually an effect on currency and internal or external prices that leads to a change in movement and trade to hopefully bring things into balance. And then, like it's saying, this whole idea of trying to pick, do you go with fixed or floated, and how do you handle the balance of adjustment payments, and how do you handle these deficits in surplus post-World War? Well, that is literally what led us into the monetary system and exchange rate system that we have today. That's why I said this is one of my favorite lessons. So that's what we have there, but we'll get into it in some of the later lessons. Hopefully you enjoyed it, but Chattadonia, that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, you went through it all for a reason. Everything you got out of it is a lesson. And remember, you can make progress by eliminating the little waste in your life. Once you learn to value it, you stop wasting it, and then the growth comes, my friend. But Chad, I love you. Drink that water. Stay hydrated, healthy. I'll see you in the morning in the AM, and have a good evening, and horn.